Everybody, we had kind of mixed results here for the market today. S&P was down a little bit, right on that rising 5-day moving average. Tomorrow we get rid of this data, which means that unless we're above that level, the 5-day moving average is going to flatten out and start to decline. So that puts us really at a place where the light is flashing yellow. Doesn't mean red, and it doesn't mean breaking this low is bearish. But if we start to get trapped below that 5-day moving average, then it's possible in the next few days we could be heading down towards the anchor from this low right here. So that is, of course, also where we saw the breakout occur, and that would be something that should be expected, and I'd love to see it tested, and then maybe a slight undercut, and then rally from there. But for now, it just means let's be cautious. The market has gotten extended here the last couple of weeks. It's been riding that rising 5-day moving average, so we've given the benefit of the doubt to the buyers. But when it starts to turn sideways in here, it's just time to be a little bit more cautious. The NASDAQ was higher here today, and this is still making higher highs and higher lows above the rising 5-day moving average. And by the way, that black anchor is the week-to-date volume-weighted average price. So we're clearly a little bit stretched here in this market. We could draw a trend line if you wanted, and we're basically right on that as well. So what would be the reason to get more cautious in here? Well, one, we've broken this band of resistance, and if we're to get stuffed under there, then we could see a decent pullback. The 50-day moving average is starting to flatten out because we'll be getting rid of this data tomorrow. So we've got, continue to be mixed messages, and when that's the case, we look at the longer-term time frame and say it's generally positive, but we're extended from 450 to 485, and that gives us reason to just slow things down and not get aggressive on the long side. Does that mean we want to get short? Not to me, it doesn't, because again, we have a rising 5-day moving average, and we have these higher lows above it. Breaking that would not make it bearish, but if we were to get stuck below it, just the same thing I said for the S&P 500, then perhaps we start to see a little bit deeper profit taking. The Russell 2000 had been looking like it was setting up a perfect little flag pattern, and as I warned to Alpha Trend subscribers last night, we don't want to be a buyer of this. One, it's as I've been saying for the past several months, really, it's just too squirrely in here, and just because it's looking like a flag doesn't mean it's a buy. It was up on bigger volume, increasing volume, and it's declining on light volume. But the fact is it's declining more than we really want to see. It's below the anchor from the September low, and perhaps we're going to test the month-to-date anchor. This is something I sketched in last night as a possibility for what this market might do. In other words, what I was saying is if it's going to be bullish, I'd love to see a shakeout first. And this could be that shakeout in here, but it's not. We have no evidence that it's a shakeout yet. Right now, what we do see is we have a declining 5-day moving average, and tomorrow it will continue to decline as we average this data out with, even if we rally, that 5-day moving average will decline. So it seems likely that we're going to maybe come down into this area here, the month-to-date anchor, which will approximately find the 20 and the 50-day moving average as well. So stay away from the Russell 2000 for now. Micron is reporting after the close today. We have a declining 50-day moving average. I'm always reluctant to trust a rally with a declining 50-day moving average, but I also defer to the 5-day moving average and say just because I don't trust this rally with a declining 50-day moving average doesn't mean I don't respect this intermediate term rally. It just means less trust for it, and when you have a big catalyst coming like we do today with Micron after the close, then that means that you've got to be much more cautious, and perhaps you took some profits. Perhaps you bought some puts. What do you do to control your risk? Maybe you reduced your size. If we start to see a deeper pullback, let's say we see a flush, I think down to this level would be the first area, and then into that 50-day moving average. It would actually be good to see a pullback down into that level, into the 20-day moving average and the anchor off the August 5th low. That will give this 50-day moving average a few days to kind of flatten out as we average this data out, and then by the middle of next week we're averaging this data out, which means the 50-day moving average would decline and then begin to flatten. So I'd say stay away from them for now unless you're already in it, and then you know what your risk is. Hopefully you know what your risk is. Biotechs have remained a sell since I said the other day on Twitter that I've been updating this position, that I had 1/3 left, and I got out right here yesterday. and it continues to make a pattern of lower highs and lower lows. What I'm looking for to get involved in the biotechs again, it's funny, is maybe something like this. This is what I had sketched out last night on Trader TV, the Canadian show. But right now, it's nice to be out of it. I was long at 98.50, took a third here, and another third over there, and now I'm out with a profit. Why do I care if it's going down? I don't. I'd love to see it reset at a lower price, and then perhaps the next time we see it rally strong, then it can finally go break this level of resistance here on the weekly time frame and start to fulfill some of the promise that's potentially here up towards that 120-ish level. But intermediate term, from failed moves here, from that failed breakout last week past these highs, came this fast move lower. And if you don't have a plan, you're either regretting that you still hold it, or maybe you're averaging into it. I say don't buy the dip. There's no reason to buy in here. Buy strength after the dip. Wait for that 5-day moving average to come down and flatten out. So far, it's following the script of what it's supposed to do. It's not a prediction. It's meant to be. This is market structure. This is what I've written about in my books. I get questions all the time about it, and the answers are they're straightforward. They're right there in those books. Financial stocks undergoing a little bit of profit taking, and they're below declining 5-day moving average. They're below the anchor from the low of this month. They're below the 20-day moving average. So some people will call this a double top, and as we know, a double top is only confirmed once we break below 43.50. That's point B. This is point A, B, C. Then point D is when we break the trend line. Point E is right here. Then ideally we undercut it and then come down, and the measured move would imply, if this is a double top, and I'm not trying to call one here, but the height of this pattern, we would subtract the height of this pattern from the point of breakdown, and that would probably put us down near that year-to-date anchor and the 200-day moving average. That's thinking too far ahead right now. There's no sign that this is a double top. It's just a level where we've seen supply release twice, and it's been rejected in there. But we're below declining 5-day moving average. That's the key. That's what we need to look at and say there's no point in buying while it's below the declining 5-day moving average, just like there wasn't over here. You buy above the rising flat to rising 5-day moving average if you're looking to buy this. It's just that simple. Energy names continue to do what they're supposed to do. They found supply at that year-to-date anchor, the 50-day moving average. The year-to-date, year-to-date anchor is that thick blue line. The 50-day moving average is the thin blue line. The 200-day moving average is here. These stocks just look terrible. Everyone talks about Occidental Petroleum, and Occidental because Warren Buffett's been buying. Well, guess what? This isn't a stage 4 decline. This is a bear market for this stock. Maybe it's going to reverse, but not with a declining 20 and 50 and 200-day moving average. The odds simply aren't there. Now we're back below the declining 5-day moving average. Looking for, the low-risk trade is probably a short as it breaks down right here with a stop above a high in this area. That's not set up yet. Anyways, energy names, I'd say just stay away from them.